Currency Pro Part 4, Inflation and Currency Movements. In this video, I'll cover how inflation impacts currencies and how currencies impact inflation. It's a bit like the chicken or the egg. It can happen both ways. A weakening currency can increase inflation, but increasing inflation can also weaken a currency. Let's start with how currency impacts inflation. If a currency is getting weaker, that makes the imports from other countries more expensive. So for a simple example, let's say $1 is worth 7 Chinese Yuan. If we want to import some Chinese toys that each cost 1 Yuan, we can get 7 of them for $1. But then let's say the dollar weakens against the yuan, and now each dollar is only worth 6 yuan, not 7. Well, if the price of the toy stays the same in China, we can now only afford 6 of them for $1 when we used to be able to buy 7. Or put differently, 7 toys used to cost $1, and now 7 toys would cost us $1.17. That's inflation driven by a weakening currency, which would only impact imported goods or goods with imported components. But for a wealthy country like the US, that's a lot of them. Higher inflation can also cause a currency to weaken. Again, this comes down to supply and demand. Let's say lots of foreign investors own US bonds, which is true. Most bonds pay a fixed return and you get a fixed amount of money back at some future date. So if inflation is high and the dollar is getting less and less valuable over time, foreign investors might not want to stay invested in something that's losing value. So rising inflation can actually cause foreign investors to pull their money out of a country. That selling activity, or falling demand if you will lead to a weakening currency. This dynamic is most noticeable in emerging markets. Countries with persistently high inflation tend to have their currencies weaken over time. I still remember an early currency lesson I learned in high school. I found out in Mexican bank accounts you could earn 5 or 10% interest. I can't remember what the exact percentage was, but it was way higher than the US. But I remember learning that it wasn't necessarily as good of a deal as it seemed, because Mexico had higher inflation, and that meant its currency might weaken. Well, back then it was about 11 Mexican pesos to the dollar. Now it's 17. So you would have made more in interest, but lost over half of your value from the currency depreciation. In the end, I'm actually not sure which one would have left you better off. Probably the Mexican bank account, but the currency depreciation certainly did eat into some of the return from the extra interest. Now, I didn't know it at the time, but if I had put my money in the Mexican bank account, that would have actually been pretty similar to a common currency trading strategy called a carry trade. The only difference is that in a carry trade, you actually borrow money in something with a low interest rate and use that money to buy something with a higher interest rate. Often this is done in currencies, and typically it's done all at once through a derivative product called a currency swap. I'm not going to dive too far into swaps here, but essentially you'd be paying the return on the treasury bond and receiving the return on the Mexican government bond. Right now, a 1-year treasury bond pays about 5.5%, and a 1-year Mexican government bond pays about 11.5%. So there's a 6% carry, aka extra yield. However, that extra yield comes with extra risk, and currency swaps are usually more a tool for companies and governments more so than individual investors. Those are the areas I'll cover in the next part of this course, starting with companies. And by the way, this is a 10-part course that's gonna roll out over 5 weeks on YouTube. But if you want access to all 10 parts right now without clicking around YouTube or watching ads, check out the link below. Thanks for watching.